Hey guys, alright, so this is going to be the last video for Chapter 10 non-monetary exchange, and basically what we're going to do here is that I've got like 5 different scenarios that we can go through, and we can work through them and see what are the different iterations of this topic. There's all these different buckets that we have to know that we should be aware of at this point, and so this video is just going to be relatively quick. It's just going to be working through the mechanics. I'm just going to do the plug method because going through both methods is kind of a lot of time. If you want to go through the formula method, I would just kind of maybe have that out with you and then go through it. It's definitely a good way of doing it, and it's a good way of checking your work. It's just if I do it for every problem, it's going to take way too long. So let's just see what we've got here. We've got 2 companies, XYZ and ABC, just to make it simple. And we've got a bunch of facts, the equipment, how much it costs them, their cumulative depreciation. Don't use this abbreviation unless the professor says it's okay. I only did that just to shorten it a little bit, so don't have to write it out every single time. But fair value of the equipment and then cash given up. So the first set is with commercial substance. I have the actual journal entries written out ahead of time just so it's a little quicker. But yeah, so with commercial substance, what would happen? Well, this is the easiest case, right? We're going to recognize all gains, all losses. If we see commercial substance on the exam or on a quiz or something, we're happy, we're smiling, right? We're in a good mood because this is the easiest of the different scenarios, okay? So with commercial substance, we know that we'd recognize all gains and losses. Let's just calculate the gain or loss. So we take fair value, we subtract away book value. Fair value in this case is what, 23,000? Sorry, I forgot to say, we're doing this from XYZ's perspective, okay? The journal entries. So fair value of equipment, 23, book value would be 15. How did I get 15? Equipment at cost minus accumulated depreciation, so 20 minus 5 would be 15. Gain, $8,000. Okay, so then we have everything we need to do our journal entry. So we can plug in the gain, $8,000. The first thing I probably would have done was just put in accumulated depreciation and equipment at cost, which is 20,000, because those are just straight up given. They're the easiest ones, and cash is also given. It's 2,000. So now we just have to plug new equipment, which ends up being 25,000 if you do the math. 20 plus 2 plus 8 minus 5 would be 25. All right, so that's the easiest one. Now we're going to change the facts. Now we're going to say assume that the fair value is 14,000 right here for XYZ instead of the 23, and then 16,000 for ABC. That's just so that way 14 plus 2 equals 16. That's why I've changed ABC as well. So in this case, we can see we have a loss. Okay, once we actually do out the math, we would say fair value versus book value. Again, book value, we don't have to redo it. We know it's 15,000. Fair value is 14, which means we would have a loss of 1 from the perspective of XYZ. Okay, so we could go ahead and plug that in. We would say loss on disposal of equipment is 1,000. Accumulated depreciation, again, that's exactly the same thing. Equipment is also the same. It's 20,000. Cash went out at 2,000. That's the same. And then we would just go ahead and plug our equipment account. If we do the math, we get 16,000. 22,000. 20 plus 2 minus 5 minus 1 equals 16,000. All right, now down to the bottom. And again, the loss one is the easiest one. If I didn't say that, it's relatively easy just because we're always recognizing the losses. If I forgot to say that, right? So this one's relatively straightforward as well if we have a loss. But now we're going to get a little more complicated. Now we're going to say it's the same as the original. So all these facts up here are the same. But now we lack commercial substance. All right. So what are we going to do now? Now we need to figure out whether or not we're recognizing a gain. All right, because now we lack commercial substance, now we're worried. And again, for the loss, it doesn't matter if we lack commercial substance or have commercial substance, we always recognize the gain. But for gain, we always recognize the loss. I apologize. But here we have to see, we would know that we have a gain, right? Because we've done that math already. We would have done this calculation, saw a gain of 8,000. And then we would see, okay, we lack commercial substance. Well, are we going to recognize a gain? Well, if we think back, we would say, okay, we're in the situation where we're paying out cash. Okay, and if we're paying out cash, then we're either going to recognize all of the gain or none of the gain. Okay, we can actually see right here, cash paid, recognize either all or none of gain. All right, so when would we recognize all the gain? Well, we would recognize all the gain if the amount of cash is 25% or more of the fair value of the transaction. All right, and so basically the way that we determine how much percent the cash is we do our little ratio, as we've talked about in other videos. But basically, the ratio is cash involved in the transaction, and we would divide that by the total fair market value of the transaction. All right, a little shorthand, but that's what it is. Cash involved in transaction, pretty easy, straight up $2,000 given to us. Total fair market value of the transaction would be $25,000. And we would see that would be only 8%, which is clearly below 25. How do we know 25%? How do we know this is 25,000? Well, we have to compare. We have to say, okay, the fair market value of what ABC is giving up is 25. The fair market value of what XYZ is giving up is 23 plus 2. Okay, so that means they equal, and that is the total fair market value of the transaction. Okay, the total fair market value of everything involved. So we didn't meet our test, which means that in this case, we're recognizing none of the gain. Okay, we would recognize all the gain if we got to 25% or more. All right, when we're paying out cash. So accumulated depreciation, again, is still 5. Equipment is 20,000. Cash is still 2,000, which means that the equipment account is the one that's affected, and it goes down by 8 as compared to the initial one, the initial journal entry, because the initial journal entry is 25, this one's 17. If we do the math, we would see that the journal entry is balanced. All right, now we're going to flip it over. We're going to have to flip back and forth a little bit, but we only have 2 more scenarios. We're almost done. Now, we're going to assume that the cash is $9,000 that is given up by XYZ, and the fair market value of XYZ's equipment is $16,000, but ABC's is still worth $25,000. Okay, so now we lack commercial substance still. That it doesn't say it, but I meant to say we lack commercial substance. Okay, so that's the big point here is we lack commercial substance, but now we have more cash. Okay, we have more cash being paid by XYZ. So here we would have 16 here and 9 here, and this would be still 25,000. All right, that's basically the change for this one. So now we have to do our test again. Okay, our test would be, again, the cash involved, which is 9,000, and we would divide that by the total fair market value of the transaction, and we get 36%. Okay, 25,000, which is the $25,000 from ABC's perspective, which is the fair value of their equipment, or from XYZ's perspective, they give up something worth 16,000, they give up something worth 9. Well, that's 25,000. Okay, so now we're clearly above the 25% threshold, and so now we're in the situation where we're recognizing all of the gain. Right? So we're in the situation where we're paying out cash, we lack commercial substance, it's all or nothing. All or nothing. Okay, all the gain or none of the gain. All right, so now let's go ahead and figure out, so accumulated depreciation still 5,000 as it has been. Our equipment would be 20,000 as it has been. Cash changes, okay, so that's 9,000. The gain actually changes because the fair value of the equipment changed. All right, we're going to recognize all that gain. We know that, but we just have to calculate the gain. Okay, so fair value is given to us up here at 16. We know that the book value is 15,000. Okay, and the reason we know that is that the cost was 20, cumulative depreciation was 5. We see that in the facts at the beginning as well, right? Equipment cost 20, cumulative depreciation of 5. That hasn't changed. So that means that the book value is 15. Our gain is 1. So we'd have a gain of $1,000, and then the equipment, the new equipment goes on the books at 25,000. If we do the math, we just do 20 plus 9 plus 1, that's 30, minus 5 equals 25. Okay, let's go through the very last one, and then we're going to be done with this topic. I know there's a lot of videos on this topic. It's just relatively challenging, so I just wanted to be thorough and give you guys as much resources as I possibly can. Let's see. Now assume that ABC is actually going to be paying XYZ 2,000, and then now ABC's fair value of the equipment is 23,000, and XYZ's is 25. Okay, so let's take a look at that. Now, instead of these facts here, ABC's fair value is 23. They're paying cash of 2. XYZ gives up no cash, and then the fair value of XYZ's equipment is 25. If I've done that correctly. Okay, that's what we have. All right, so now from XYZ's perspective, they're going to be receiving cash. Right, they're actually going to receive cash of 2, and they're going to receive something worth 23, and they're going to give up something worth 25. So those are, this plus this equals this. So we're still good in that sense. All right, but now we're in the situation where we are receiving cash, okay? And so now we receive cash, we go back to our little cheat sheet, recognize either part or all of the gain. All right, recognize either part or all of the gain. All right, and so again, we're going to do our little test for whether or not we hit over 25%. If we hit over 25, we recognize all the gain. If we do not hit 25%, then we end up in a situation where we recognize part of the gain. Okay, so again, once we hit 25, recognize all the gain. Under 25, recognize part of the gain. I just wanted to point out before, under the ones where we're paying out cash, the reason we're doing this is only to see if we're recognizing the full gain. Okay, and then the same thing here. We're only doing it to see if we recognize the full gain. There is no partial gain under the pays out cash transaction scenario. So now we'll do our little calculation and we'll be on our way. We know that there's $2,000 of cash involved. It's the same formula, $2,000 of cash involved. The total fair market value is $25,000, which means that 2 divided by 25 is 8%. And so we can clearly see we are under the threshold once again for whether or not we would recognize the full gain. So again, we're either recognizing part or all of the gain when we have cash received. We don't hit 25, so we recognize part of the gain. So now we have to calculate that. So we know we're going to multiply the total gain by 8%. Total gain by 8%, and that's going to give us the gain recognized, which is a partial gain. Okay, gain recognized. All right, so let's figure out what the gain would be. So we can flip back here so it's easier. We know that the fair value of the equipment is now $25,000. That changes. We know that the book value is still 15, right? So 25 minus 15 would be 10,000, okay? So we would have 25,000 of fair value minus 15,000 of book value. We would end up with 10,000 of total gain, but we're only going to recognize 8% of that, so we recognize $800. So let's go ahead and plug that in, $800. Then more or less the rest of it is the same. Now with the accumulated depreciation is still 5 as before. The equipment that goes out is still cost 20,000. We pay out cash of we receive cash of $2,000. ABC pays out the cash, but XYZ is receiving cash of 2. Then we just plug the equipment account. If we do the math, we get 13,800, which is 20,800 minus 7,000, which is 2,000 and 5,000. Okay, so that's basically it for this video, guys. Look for more videos, and good luck. Thank you.